Hello everyone, we are back and it is time to finally update these graphs. So let's start with our annual dividend income. Bam, at 101.96. Let's update our actual monthly dividend income. It was a lower month after we received our very high $13.13. We received $6.85. And then last but not least, let's update our portfolio value. So you can see the three pieces of data from this month's chart, and you can see how the portfolio is doing very nicely. A very steady upcline on the annual dividend income and the portfolio value, and then I'm sure next month for the monthly dividend income will be higher than 685 as we just made another deposit. And speaking of deposits, like I mentioned to you guys that watch me frequently, these are the dividends that I received for the month of July, by the way. If you want to stop any of these, you can pause it. We have Coca-Cola, Kimberly-Clark, Altria, Realty Income, Store Capital, WP Carey, Cisco, and JP Morgan Chase. But like I mentioned to you guys that watch me relentlessly, you know that I just bumped up my deposits from $25 up to $100. So this portfolio is about to start taking off. I did just deposit $100 to the platform yesterday. I'll be doing it every Monday, more than likely. And we are now up to $3,134, about $101 up from our previous $30.33 that we marked on this graph. But I will be updating everything month by month. And not only will I be updating for the month, will I be updating my portfolio value, my dividends, I will also be updating you guys with my analytics, with my subscribers. So let's go ahead and look for the month of July. Something I wanted to point out here. Let's go to my videos real quick. If you go to my videos and you go to my last monthly updates right here, July 2020, I did an update around this time and I had about 700-ish subscribers during that time. Now today we have almost double that. We have about 1,349 subscribers, and that is absolutely incredible, guys. I don't hide anything from this channel. I don't hide any of my investments, anything that I'm buying, anything that I'm selling. I don't hide the dividends that I'm receiving. I don't hide what I deposit. I don't hide the subscriber count. I don't hide the amount of views that I get. And I also don't hide this tab right here, which a lot, and I mean a lot of YouTubers hide. I will be showing you every single month. I will also be updating the revenue that I receive from YouTube during this time. So if we go ahead and click July here, where's July? We go ahead and click July. So for the month of July, I finally got monetized and we received $94.83. So this tab over here, we're going to start adding up the amount of money that I've made from YouTube, and this gives you a good idea of what a YouTube channel makes. A lot of people, like I said, do not disclose any of this, but I'm not going to do that. I'm not going to do that this way, and this is how we're going to do it. I'm going to share everything publicly, so at least those of you guys that are forced to watch some ads, maybe you can at least see some of the progress that it's given me and my channel and see how it can benefit you if you ever wanted to start your own YouTube channel. Okay, so the total now is $399.83. This stays the same, so we take $399.83 minus $382.69, and that leaves us a net profit now since starting the YouTube channel about 4 months ago today, and that leaves us with a net profit. We are finally in the green of $17.14, and everything is profit from here. And let's just break down my YouTube income before we start getting into my investments. If you see here, we have PayPal fees, people that have paid me for my mentoringship, which that is where $65 of my income has come from. Taxes, I'm setting aside some for taxes, but I've not paid any of that yet. I once hired someone for my thumbnails, and I paid a little bit for thumbnails. Equipment, miscellaneous stuff like microphone and some other pieces of equipment like that, and then some software and editing. And all in total, it's taken me about $400 to start the channel, and we are now made about $400 worth of income. I have mentoringship, which is link in the description if you're interested. I have ads, which I just now got monetized for. Anytime I sign someone up for M1 Finance, I forgot to update M1 Finance. So actually, we need to add $20 to that. So it is now a $200 bill. So now that this total is $399.83, we will add 20 to that. So that will make it $419.83. Then we can actually add 20 to this. So what would that be? $37.14. 30 So we're actually 37.14 in the profit. So great there. I forgot to add that M1 Finance referrals that we received the other day. And speaking of M1 Finance referrals, this is a good time to go ahead and plug. We have a referral link in the description. If you're wanting to get started with M1 Finance, Not only do you get to see my entire investing portfolio, but you get to see how M1 Finance works, and you can get a pretty good idea of how the platform, whether or not it's a good idea for you. If you're a dividend investor like me, it is by far the best platform that you can use. But overall, guys, just thank you for subscribing to me. Thank you for supporting the channel. It is a dream to be able to get to where I'm at. There's a lot of people who are way farther ahead than I am, but it still means the world to me. So thank you guys so much. But let's go ahead and start with my investments, and let's just see how I've done in general. If we go by a time-weighted return, I'm up 14.07%, 386 coming from unrealized gains, and you can see my portfolio here. And then if we go back to my main portfolio, to the main screen, we have a money weighted return, which we are up 22.67%, 459.24 coming from total gains, 431.96 coming from market gain, and then 27.28 coming from earned dividends. So next we're going to jump right into all of my holdings one by one, just give my opinion, give why I hold them. And the reason why I do this is for those people that are new to the channel, or some people that have forgot or have not seen all of my previous videos. I want to give you a chance to break down every single position that I hold and why I hold them. So I focus on both dividend growth companies, companies that grow their dividend, and also ones that have a high yield. And let's go ahead and start with my number one holding, which has both of those. It has some excellent growth with its dividend going about 8 times the price of what it was 5 years ago, and it also has a great yield of about 4%. Broadcom is an excellent tech company. They are a semiconductor company. You can pause and read the description here if you're interested. They're based out of San Jose, California, and they are an extremely profitable company with one of their number one customers being Apple. So they are going to be successful in the long term, and they're really focused on growing that dividend, and their CEO has even said they're going to be able to maintain that dividend. Next up, we have Realty Income. Realty Income is a stock that I believe every single dividend investor should hold. Every single one. Everybody should have Realty Income at some point, and it has nearly a 5% yield now. Because not only is this a wonderful, well-run dividend company, but they pay out monthly and raise the dividend quarterly. You heard that right. So they raise it 4 times a year, and I believe they've already raised it 2 times in 2020, and they are up to 23 cents in dividends, and they only paid out 19 5 years ago, and they are an excellent, excellent real estate investment trust. They have over 6,000 different properties diversified between all different types of areas and businesses, and they are going to be very successful in the long run. Now let's go to Visa, my third stock. I'm up 18.55% on that, and this is one of the only growth stocks in the portfolio that I have. With Visa, it is a long-term growth story. I don't really care so much about the dividend. They do have a very fast-growing dividend, and I think that eventually the dividends will start to look okay several years down the line, maybe 5 years down the line, but I'm not really owning this so much for the dividend. I just believe in the company. I'm just a huge believer in Visa. I'm very bullish on the company, and I love Visa as a consumer, and so I am going to be a buyer of Visa at just about any price for the next several years. I think they have a lot of long-term growth ahead of them. And if you're not a believer in Visa, I always like to point out in these videos one statistic that will probably change your mind. 85% of the world's financial transactions are still done through cash. Cash. No credit cards, no debit cards, no checks, cold hard cash. So while I'm not seeing them in America like everybody is using credit and debit cards, 85% of the world is still using cash. So I think that this is a long-term growth story for Visa, that they can grow into those international markets, and Visa has one of the highest margins of any businesses that you'll ever see. Fourth, we have Southern Company, which I'm about break even on from where I bought it at. It currently has almost a 5% yield, and it has come down a long way from this recession and has not really covered since. Now, they are just a basic utility company, not a lot to go around. They are a very boring business, not a lot will change with them, and that's exactly what I want. I want the boring businesses. I want the stuff where things don't change very often, and I think that this is going to continue to grow its dividend every year, like it did already raise in 2020, and I think they're on a complete doing share buyback, continue to grow the business, be more and more profitable, and I think it is an easy money stock. That is a very easy money stock for very slow and steady returns. And speaking of easy money stocks, let's go ahead and go to Pepsi, which I'm up about 9% on. Pepsi is a company that I love. As far as a consumer company goes, it is arguably my favorite stock on both a consumer basis and an investor basis. I love their products, and I love them as an investment. They have about a 3% yield. Their dividends, I don't know why it's done this with M1 Finance for a while. This one little dividend cuts out only for Pepsi, so they did not pay dividends. They paid dividends every year for about a 50-year streak, and they raise it every year as well, so just ignore that. But they're up 35% as well, even in a recession, and you can see that they've held up very well. And they did just report earnings the other day, and they came out very nice that their snack foods were thriving in this recession, and their beverages were doing okay as well. I think Pepsi has such a large, dominant brand in the beverage and snack space that I couldn't ever see them going bankrupt. The only way Pepsi ever goes bankrupt is if people stop eating and drinking. As long as that happens, we'll be fine. Next up, we have one of my newer-ish positions. We're up about 1% on one of my other real estate companies. I own 3 different real estate investment trusts, and this is my second largest one. WP Carey, very diversified, triple net lease real estate investment trust. Those of you that don't know what triple net lease means, it means that they're not responsible for paying the taxes. They're not responsible for the maintenance. They're not responsible for a lot of the other headaches that a lot of real estate investors have to deal with. They basically provide the building, say you're responsible, pay us a fee. And that's pretty much what's happening with Realty Income. That's what's happening with WP Carey. And then my third real estate investment trust, which I'll show you in just a moment. They're diversified between the United States, between Europe, and some other areas. And they have about a 6% dividend yield. So much higher than that of the average market, about 3 times than that higher than the average. But next up, we have 3M, a very, very old dividend king, where we're up about 7.5%. 3M makes thousands of products. I believe it's 6,000 different products. They have about a 4% yield. They raise that dividend every single year, including this year, and they are about break even from where they were 5 years ago, and I'm just up a couple percent on 3M. And this is such a great, incredible industrial company. They've been around for a million bajillion years, and they're not stopping anytime soon. I think that they're going to get right out of this recession like it's nobody's business, and I think they're going to get back on track to where this company used to be. I am a believer in that. Next up, we have McDonald's. It is up 18% in my portfolio, doing okay. McDonald's, I'm sure you all know and love it, the world's largest burger chain, the world's largest restaurant chain other than Subway based off locations, and they have about a 2.5% yield, and I think they'll do just fine once the Rona ends and we get back to normal. And they have a pretty fast-growing dividend as well as some great share price appreciation from backers like Warren Buffett investing in them, from share buybacks being at all-time highs for this company. I think that they're going to get right back on track once the Rona ends. So that 2.5% yield will keep me happy until that happens. And now, speaking of dividends that I think is going to maintain through this recession, you see this big jump up here from May 18th? You see this big jump up here? I've been increasing my position in Caterpillar over and over and over, and this little jump up right here, if you haven't seen that, go back to about May 18th and go see my video I made completely dedicated to word Caterpillar. As far as all of my investments go, one of the only reasons, well, the only reason why it's probably not my number 1 or number 2 investment is just that it's so stinking cyclical. That said, when a recession hits, it does get hit hard. And when a booming economy hits, it goes significantly higher than that of the market. So it is a more volatile, more established stock. Usually when you have a $70 billion company, they're usually more established and a bit more stable, especially one that has steady dividends like this, but it is a bit more volatile than the rest. That said, I love this company. The management team, excellent. The balance sheet, excellent. The financials, excellent. The business model, excellent. The consumer brand, excellent. I love the dividend yield, the dividend growth. There's so many things I love about the company, and to figure that we are in the worst of recessions, we are in a horrible time right now with the economy, the fact that this still has over a 3% yield, and they have been able to maintain that dividend. They did pause on a raise this year because of the recession. If anything, I think that might even be a better thing so they don't destroy book value or put themselves in more debt. I think that is perfectly fine as long as they can keep that dividend at the payout that they set. I will be perfectly happy, and they did just that. So I'm very excited to be a proud owner of Caterpillar, and I will be buying more of the stock. If we see any more of a downturn, if this stock goes even lower, I'll consider even bumping it up another target percentage in my portfolio like I already did a month or 2 ago. Next up, we have Coca-Cola. We're about break even. We're at 4% on it. I did bump this up in my portfolio when I first started back in April, back in May, around the same time that I did Caterpillar, and this is up 10% over the last 5 years. A steady growing dividend. I don't need to explain Coca-Cola. You all know it. You've all drank it. 3.5% yield, almost a 4% yield just to own the stock. Just to own the stock. So if you think Coca-Cola is not going to go bankrupt anytime soon, go ahead and buy it today and lock in nearly a 4% yield just to own it. Next up, we have the best performer in the portfolio. We are currently up about 103%. You heard me right, 103%. They make the washer and dryer in my laundry room, and they make tons of just basic household appliances. And I hadn't even really had the chance to buy this stock because the moment after I bought it, I think the day I started the portfolio, I think it was April 6th. So yeah, I started buying it in the high 80s. What was my average cost? I think it was 87. 86. 86.74 is what I bought it at. And you can see today it's $164 a share. An incredible run up for Whirlpool. I remember seeing this company, and while I do think their dividend isn't as safe as a lot of others, I remember seeing their valuation and just thinking, wow, this is just so undervalued, and nobody's paying attention to the stock. People undervalue the stock because it is such a boring older business model and they have very, very slow revenue growth. I think people are still not giving the stock enough credit, even at $165 a share. It wasn't until the last week or so they came out with an earnings report and they were up 10% on the day they reported earnings. The craziest thing is that you think that the stock has doubled from where I bought it at, and it is still getting a 3% yield. I think that it is still a buy. I am still buying Whirlpool at these levels at a double up. I've raised my cost basis many times, and the funny thing is I said $86, $87 right here. Where I first bought it at, I think I bought it right around 80 bucks. It might even have been in the high 70s because I've raised my cost basis 2 or 3 times buying more and more of this company, and I think even buying this stock at $160 a share is still not a bad buy. So don't sleep on Whirlpool like all the other investors have, and I performed very nice on that. And speaking of stocks that I've performed very nice on, stock that I'm up about 37% on, pays about a 1% dividend yield, is Microsoft. It has a steady growing dividend. They're a large tech company, and I don't really like investing so much on high growth tech companies. Like I said, I own 3 different growth companies, and after this month, which I have not mentioned yet, we are now down to 2. I had Visa, I had Microsoft, and I had Apple until the other day. I finally ended up selling Apple for about a 70-ish% gain. I bought it at around 250 a share, and then it jumped up all the way to 420. I'm a believer in Apple. I believe in the company. I might even buy it back in later on, months down the line, if we see any kind of share price depreciation, but I just can't own it. I can't own it at 420 a share. I don't believe that it's worth that much. And to be fully honest, I think even Microsoft might even be a little bit overvalued at these levels. But I'm a believer in Microsoft, and I want to have at least a little bit of growth in my portfolio. And considering that Apple paid about a 0.7% dividend, I'm not going to own it. So I'd rather fund it into other stocks, which I'm going to get into in just a second. One of the only stocks I'm down in my portfolio, we're down 1%, so about break even really. Store Capital, my other real estate investment trust, I think that the stock is really interesting. They're kind of coming up with a new age way to invest in real estate. They only base investments off of financials of the company and not their credit rating. So it's really interesting, and they primarily focus on services. That's why they've been hit so hard, but they're still up 15% in the last 5 years, and they do have a 6% dividend yield. 6%. So if you buy it today and they're able to maintain that dividend, you're already guaranteed a locked in 6% annual return regardless. So that is pretty incredible. Waste Management, we're up about 18% on. I love this company. I've made videos dedicated to this, and it just went from 39 cents up to 55 cents, 2% dividend yield. And basically with Waste Management, if you make trash and you throw out trash, then you're probably a consumer of Waste Management or a business very similar to this. They basically just clean up trash. It's that simple. If you see the big green trash trucks that say think green, think clean, that's Waste Management, and they drive those natural gas trucks, and they pick up your trash, and they are very profitable in doing so. The world's largest healthcare company, 7.5% is what I'm up on it. Johnson & Johnson, one of the oldest, safest, highest investment grade companies that you can possibly invest in is Johnson & Johnson. We are at a 2.6% dividend yield, and it steady grows that dividend every year, including this year from 95 cents up to $1.01. You can see that investors are so dedicated, almost like a cult stock. They are so dedicated towards owning this stock. You can see that it's nearly at all-time highs. It's 147 a share, and the highest it's ever been was about 155. So we're about 10 bucks off from its previous all-time high, and I think that this is going to get right back there in probably a couple months, if not the next year, and I think that the dividend is going to grow as well in that time. And speaking of stocks that have held up very well through this recession, is Kimberly-Clark. We are up about 17% on it, and it just hit its all-time high. Just hit it recently, just the other day, and it is paying about a 3% yield still, so I'm still buying the stock, even at all-time highs. They grow the dividend, they have a great yield, they're a very, very old company, and I don't think they are going to stop anytime soon, and they are hitting all-time highs, and I'm sure that they're going to continue that run up. Now, Altria is our next stock. We're up 13% on it. And this is really, really interesting because Altria is one that I just beefed up my investment, if you can't tell. You can see its performance track record right here, and then poof, a huge jump up. You can see that we're up 13% on it, and Altria is a stock that I decided to bump up, and I will tell you exactly why. I mentioned in some of my previous videos, I was curious as to whether or not Altria would be able to maintain their dividend. I thought for sure, okay, they're not raising their dividend this year. We'll be lucky if they even keep it. They'll probably end up cutting it or slashing it, one of the two, or at least suspending it. Not only did they keep their dividend, but they raised their dividend. You see their payout of 84 cents here. They just raised it to 86. So where I bought more of it at on that big jump up the other day, I think it was about an 8.4% yield. So that was my main thought there with Apple. I took most of my money with Apple and I bought two companies with it. I bought Altria, and the one right below it, I bought JP Morgan. And basically the way I thought of it was, I'm not sure if Apple is going to have a downturn either tomorrow or a year from now in share price, and I think it's starting to get a bit overvalued and the dividend is starting to get pretty insignificant. But with Altria, I can lock in a guaranteed 8.4% return. Now that doesn't count share price. We know that share price will go up in the long term. In the last year it is down a little bit, but in the long run Altria will get right back to where it used to be. But regardless, I bought it at about $41 a share. If it never broke above 41 a share, if it just stayed flat, never recovered, I'm still getting an 8.4% per year compounded. So that is why I ended up buying Altria and JP Morgan. And in JP Morgan, you can see the big jump up there. I'm up 10% on it. In JP Morgan, I wanted more exposure to financials, and there's not many other companies that I want to own in the financial sector other than JP Morgan. They have about a 4% yield. They've maintained their dividend throughout this recession. I don't think it'll be getting raised this year because I don't think the Fed will allow them to. But that said, they have kept their dividend. They're up massively, and they are an extremely profitable company. This is a company that is making billions with a B, billions of net income, even in a recession, even as they're increasing their reserves, and I don't think that's going to stop, especially once we start to recover from this recession. They're going to be extremely profitable and go right back to all-time highs with share buybacks, with revenue growth, with profitability, and I think they're going to grow their dividend as well. We were up 67% on Discover Financial. At one point, we were actually up almost 100% on Discover Financial. And you can see that this stock has treated us very well. If we look at the year chart, I started buying it around here in the 20s and the 30s, and it is now up to about $50 a share, about a 3.5% dividend yield. Where I bought it, it was about a 5%. And you can see that the stock has been hit very hard as a lot of people get negative about credit card debt and consumers are not going to pay back their credit cards. But that said, I think they'll be just fine. I think that they'll probably keep their dividend, and I think that their share price will continue to perform well in the future, and that is one of my other financials company. Procter & Gamble, same thing as Johnson & Johnson, up 17% on it. Very safe, old, high investment grade company, and they are at all-time highs, and I don't think they're stopping anytime soon. Already raised dividends in 2020, just the previous quarter or two, about a 2.5% yield, and this is pretty much arguably one of the safest dividend stocks in the entire market as far as a high yielder goes, and I think Procter & Gamble is going to do just fine. A very old blue chip stock. A stock that has now become one of my best performers. You see this big jump here. I didn't buy more of the stock. They've just had up and away with their performance on their share price. They have skyrocketed to an all-time high by far. You see their previous high was about $93, $94, and now they're $110. I think the other day, let's see, at one point, yeah, they were about $113, $114. So they are doing very, very good. And this is one of those stocks I probably didn't want to own until I retired. This is one of these stocks that I want to own for the next year, the next 2 years, the next 3 years to take advantage of 5G, because not only will that dividend be beefed up significantly, but their share price gains I think is going to get a lot higher than 110. I think we'll see 130s, 140s, 150s once we get a year or two under our belt, and I think that we'll easily double up on this stock with an average share price of 72. I think we can get the stock to the 150s if we give it a year or two. Next up in the portfolio, we have Verizon. Verizon, a telecommunications company. We're up 6% on it. A very steady payer. Not a lot of share price movement. It is very steady, very defensive, and that is perfectly fine because it gives us a 4.3% yield just for investing in it and a steady share price and dividend growth in the long term. And I think Verizon, I don't need to explain it to y'all. It's a cell phone company. You know how it works. They get steady revenue from people that have their cell phone. The only energy company that I own is NextEra Energy Partners. 62% is what we are currently up on it. About an all-time high, actually maybe at its all-time high. Yeah, I believe it just hit its all-time high the other day. Recovered very nicely, and this does not raise dividends annually. This raises dividends quarterly. So you can see the huge dividend growth each and every quarter, sometimes as much as like 10% per quarter. So I think that they're going to do very good in the long term, continue to raise that dividend quarterly, and the share price gains I think will be massive in the long term. And speaking of share price gains being massive in the long term, Home Depot just continues to amaze me. Not only is it at all-time high, you can see the 5-year chart here, but the dividend and the share price, it seems unstoppable. They raise the dividend double digits pretty much every year, 10+%. You can see in the previous year they raised it about 10% again. And I know that they're due for another dividend raise in 2020, and I think that they're probably going to raise it 15, maybe even 20%. They're so profitable. They're still at such a high growth stage, and it is so crazy to say that about an old retail store that is a $300 billion company. It is crazy for me to say that, even with a company that has doubled its share price in the last 5 years, and it is probably, what is it? Yeah, about tripled their dividend almost in the last 5 years. This is an excellent company. I do love this company, and every time I think that they're probably going to hit a roadblock, that they're probably going to slow down, they keep on amazing me. Next up, we have Duke Energy, one of my newest positions, the newest position in my portfolio. We're up 2% on it. I sold Dominion Energy and bought Duke Energy because I didn't like the Warren Buffett deal, and they have a 4.5% yield. We're hit very hard in this recession, a lot harder than they probably should have been, and they are up 12% in the last 5 years, a 4.5% dividend yield. Great dividend growth, great share price growth, and an excellent dividend yield. Excellent dividend yield for a very safe, stable dividend stock. Very safe income, and I think a 4.5% yield is a great price to lock it in at. Honeywell is a stock that has hit some downturns recently. We're up 10% on it, and I think that this stock is going to come back to normal, similar to that of a 3M. They make thousands of products, extremely diversified, a very large industrial company. You can just see how long the description is. They can't even describe all of what this company does because they do so much. But a 2.5% yield, an excellent dividend growth track record under them. They went from 82 cents up to 90 cents in the previous year, and very high growth every year behind that. Usually a double-digit grower in dividend, and I think that they're going to get right back on track once the Rona ends. Cisco is a stock that we're up 23% on, a very old dividend aristocrat. They paid dividends for a very long time, and they're up 46% even after getting hit extremely hard from the recession. $85 a share, down to the 20s at one point. Like I said, it says 31 here at the bottom. At one point, it was actually in the 20s. You can't see it, but one day on March 18th, it was actually in the 20s. This is an $85 stock, y'all. Went down to the 20s. And today, it is trading at about $52 a share, and it is still getting you a 3% yield. 3.2%. So a very good, very safe, stable company like Cisco, and they are the largest distributor of food in the world, and I think they're going to continue that awesome track record. And a newer-ish position that I'm about break even on, I'm down 1.7%, is Starbucks. It is 2% dividend yield, a little bit smaller yield than that of the average in my portfolio, but Starbucks I think has a great opportunity for not only dividend growth, dividend yield, but also share price appreciation. I think they're a bit undervalued at these levels. I think people have not appreciated their excellent business model, their excellent double-digit revenue growth, and I think they're going to get right back on track with their app, targeting millennials, targeting Gen Z. There are huge profit margins, and especially once the holiday season comes up, once pumpkin spice comes back, it's game over. Once pumpkin spice hits the markets, Starbucks is going to go right back to normal. I'm going to be buying the stock no matter what. And then the last two are the two that I lowered my position in. If you didn't see that, go back to my video that I posted, let's see, June 15th. And I made an entire video dedicated towards IBM and AT&T. Very old tech company and a very old telecommunications company. They have very high yields at about 5%, and AT&T, I believe it's around 7%. Is that what it is? Yeah, a 7% dividend yield. And I just think that their management teams have made a lot of bad moves, But that said, they have such high yields. I don't hate the company. I just don't want to risk a very large amount of my portfolio in them. So I want to see how that goes. But overall, guys, that is my entire portfolio. If you have any questions for me, if you want to ask me any questions about any positions I hold, why I sold some of my stocks, why I bought more of some of my stocks, go ahead and ask me down in the comment section. Be the 21st person to sign up with my referral link. There's tons of stuff in that description as well, not just the referral link. There's referral links to credit cards, stuff for you to sign up for, stuff that you can check out about me, stuff that you can sign up for mentorship calls, information, anything you want to know. There's tons of stuff in that description. Go ahead and let me down a question in the comment section. Any questions you have about my trackers, any questions you have about my portfolio, any questions that you have at all, go ahead and leave it down below, and I'd love to answer anything that you guys have. Thank you guys so much for watching, and I will see you guys next time.